All right, welcome to the Market Moment. My name is Matt Walters here with Eli Freeman, Lee Mackey, and we're going to jump into it today. We got a lot to talk about. But before we do that, remember you can join the growing Market Moment online community by hitting the subscribe button. Give us a like, comment. We appreciate it a lot. So today we're going to just kind of jump into it. Today we want to talk about where the market's at and what we've seen over the last few years. I think there's a somewhat of a disconnect between what people feel and what you see maybe in the headlines and what you've seen in certain parts of the market, and then kind of the reality when you take a step back and look at the broader market. It's even kind of been surprising to us, I think, just the drastic difference between different segments and different parts of the market and what the returns have been over the last few years. So starting with kind of the concentration in the market, if you look at the last several years, most of the returns have come from large cap technology, right?
Yes.
I mean, that's what's driven the market. And so with the S&P 500 being a valuated index, that's the main index most people look at, right? That has allowed and created great performance within the S&P 500 because there's a large weighting to large cap technology. If you start looking at a more diversified portfolio, which is what a lot of us personally and a lot of our clients have, a lot of the other areas of the market haven't done that well. It's actually been a pretty rough ride. So this idea that, hey, the market has just been screaming year after year after year for the last several years, and everything's at all-time highs, and we're in for this huge bubble and this huge burst. It's kind of I'm just speaking for myself, but that's kind of the vibe I get, or the feeling you get when you watch the news or you listen to clients or you talk to people, but that's not what the data shows.
No. The three main indices, NASDAQ, Dow, S&P 500, are at or near all-time highs. But, even the Dow, has some large cap tech in there that has made it, do pretty well lately. It seems like we've been talking about this, and I think you alluded to this earlier. We've been talking about this for several years now, to where we're in a concentrated market. You hear it all the time. Well, the markets are roaring. The markets are doing great. But then a lot of clients, a lot of people you'll hear talk and say, but my portfolio is not doing very good. Why is that? Well, what's one of the first things we learn about in Investing 101? Personal finance in college or high school. It's the D word: diversify. And diversification just has not paid off in any way. I'd even go back further than 3 years. You could go back probably 5 to 10 years where true diversification has not paid off.
Yeah. So S&P top 10 index. So it's the top 10 largest companies in the S&P. The S&P Global has a chart that just shows those 10 companies. Over the last 10 years, they've averaged almost 18%. So annualized return of the top 10 companies, 18%. Over the last 1 year, they're up 41.43%, with the market being up 20%.
So they've doubled the market.
And the S&P 600, which is more of your small cap, up 5%.
Yeah.
So if you look here's to give you an idea. So this is the last 3 years. This is going to, and I'm going to rattle off quite a few numbers here, but it's, the Qs, the SPY, I've got AGG in here. I've got one of the largest dividend strategies in the world in here. And then I've got S&P mid cap, S&P small cap, the Russell 2000. So I've tried to capture quite a bit.
Different segments of the market.
I've got an international index in here. These are the annualized returns over the last 3 years. So you've got the NASDAQ 10.77 and the S&P 500 8.2 annualized returns. Okay. Everything else, so that's 8 and 10 for the NASDAQ and S&P. Everything else, I'll just go down the list: -4, 0.4, 2.3, -2, 0.7, 0.1, -5. That's every. So literally, you're either flat to negative.
Yeah.
Over the last 3 years, other than the NASDAQ and the S&P 500.
The part that's difficult with that is you read any article around what goes into a good, well-built, diversified portfolio that can withstand any market cycle for a retiree, which is what you probably should strive for if you're going to live off of your portfolio. What goes into that is a mixture of large cap, small cap, bonds, international, a diversified portfolio,
Large cap value.
and large
Right,
cap
you have value,
and
growth.
If you have been invested in what any study probably has come back as this is the way that you should invest, you have massively underperformed the S&P.
Sure.
And so you're sitting there frustrated saying, well, the stock market's done this. My portfolio's done horrible. And it could be invested, quote unquote, properly.
Right.
I mean, you take you take some of the biggest names in investing, a Warren Buffett. His portfolio has significantly underperformed at times because he's not growth. And so, as an advisor, and when we're talking to clients and we see what's going on in the tech side, we would love to shift money over, but prudence, everything that we've talked about and been trained to do.
It's hard.
It is very hard.
It's hard. Yeah, it's really hard. I just pulled up the equal weight S&P 500 2.46 average annual return over the last 3 years. So you own the exact same 500 stocks, but it's equally weighted versus the value weighted S&P 500. So no, it's really hard to stick with it. I mean, we're speaking from.
But I had a client, and they may be listening out there. Last week, said, somewhat disappointed in Enhanced Div.
Mm-hmm.
Phenomenal portfolio.
It's done great.
Dividends, but in another part of his portfolio, he's got NVIDIA.
Yeah, it's just crushing it.
Yes, and so, but his sentiment is not unlike a lot of people's sentiment.
Sure.
And so, we as advisors, we've got to balance, the psychology of it, and it's tough.
Well,
and
it creates biases.
Oh, absolutely.
Because you've got that short-term bias of, well, this is working, the other stuff isn't working.
Well, and it's why there's such a spread between market returns and individual investor returns.
Plug the data brief coming out this next week. I'm actually diving into a study showing the difference between market returns and investor returns.
Yeah, because people do exactly that. They flip. They're like, well, this isn't working. This is working, so I'm going to change. And as right of a feeling that can feel so right in the moment, like you're setting yourself up. For disaster.
The study I went to was from Morningstar, and the average investor relative to their benchmark underperformed their benchmark by 1.8%.
Yeah.
So that would be like saying, let's go buy a CD for 5%, but because you're not a professional investor or because you're not in the industry and understand it, you only get it at 3.
Well,
3.8.
and you look at like a fund's performance, the investor's performance. So if you go look at the 10-year track record for a decent, mutual fund, but then you go look at the performance of most people who've been invested in that, there's a huge difference.
Sure.
Because they haven't stayed invested the entire time.
And the more volatile, the worse they do.
Yeah, sure.
And you mentioned the word a minute ago, short term. But I think that's the part that's beginning to kind of weigh on people.
3 years is short term.
It's because it's not just short term. I mean, 3 years ago, we were saying that this is short term. I mean, again, we're dealing with this for 3, 5, 7 years, to where the NASDAQ tech has so outperformed the rest of the market that at what point do we look and think, okay, this maybe is not a short term.
That's interesting.
Phenomenon.
So when do you start to say?
I don't know. I know what you're going to ask.
that the historic outperformance of small cap is done.
I think there are some. I do think there are structural changes that happen in the investing world.
Like what?
Over time. Well, I mean, this is maybe a bad example, but it's an example. Like interest rates, right? How companies manage their debt, right? I've heard listened to a lot of podcasts, people talking about how small cap companies today aren't what they were in the 90s.
Sure.
Right? And the debt they carry and the way it's structured is not the same. And so rising rates and falling rates don't impact small caps the same way as they used to. That's just one very small example, but that's a kind of structural change in that you may not be able to trade around and invest in small caps around fluctuating and changing interest rate environment like you used to be able to.
And because historically, to Matt's point, if we knew that the Fed was at the end of their tightening cycle and then the next move or moves was going to be down, his history would tell you, where do you want to be?
Cycle into small caps.
Yeah.
Cycle into small caps. Well, what do you see perform the best now when rates start to fall?
That's an interesting
It's
segue.
large cap. It's the NASDAQ.
Yeah, there's a chart. Let me see if I can pull it
So
up.
that's just one example of kind of a structural change of, I think the passive investing piece of the market is a huge structural change. How massive passive investing has gotten. And so you look at how the indices are structured with them being like valuated and how so many people just go out and buy the index.
Where money's flowing.
Yeah, you look at money flows, and that's a structural change to what. I think there's good and bad sides of that.
So that's an interesting point, and one that probably none of us are smart enough to get into build a study or a case around of the changing in market dynamics with modern day business structures around technology-driven companies, AI-driven companies, as well as passive indexing becoming a larger and larger part of the market. And I heard a point not too long ago, whenever you see the passive versus active strategies, which a lot of people each year they'll update their slides to show how much of the market is active versus how much is passive, they don't include direct indexing. Because that's just, they're using passive ETFs and mutual funds. And there's a whole nother slew of people who are passively investing, but they're directly investing into those companies. So the numbers of people who are passively investing in the market is even larger than what we're expecting. Right now, I heard an estimate that it's somewhere between 60 and 80%.
Oh, wow.
I mean, that's a significant change from 20 years ago.
Yeah. I think there's a lot that has changed and will continue to change. I do think what you have to be careful of, and this is what as human nature is, just we want to do the best we can, right? Like you see like what's doing the best, and it's like, well, I want to do that, or I want to get that performance.
Oh yeah, that's working.
And so I think it's a good reminder though to think back of like, but what's the objective? What's the goal? Like Shirk would 12% annually over the last 5 years in the NASDAQ or whatever it like, would that have been great? Yeah, but is it going to do it over the next 5 years? And has that been your objective, or has it been 8%? And can you go get 8% in a less volatile way?
Well,
right, while taking less risk and being more diversified.
And you made the comment, I think, somewhat jokingly, just a second ago. And to your point, we don't chase returns. Our models, the initials are ALR, acceptable level of risk. I mean, sure, we could all go out and invest in a fund and invest in the top 10 companies of the NASDAQ or the S&P, but why? If a client needs 4 or 6, why take the risk to go get 10 or 12? But it's tough. I mean, it stands on its head everything that we've fundamentally been taught in our investment basics. You were going to say something.
Here's interesting. Going off of what you said earlier, Lee, Bar Charts Twitter posted small cap stocks post worst first half in history relative to large caps. So small caps, and they classify small caps as the Russell 2000. Worst first half in history relative to large caps. And if you see the chart, it's a drastic number relative to the only time previous where the chart starts to look like what it does right now is back right before 2000.
And history would tell you now is the time to get in.
Go cycle.
Cycle into small caps. But the last 3 to 5 years, history would tell you don't.
Yeah, your feelings would be that small caps don't work.
Yeah.
Well, when I was pulling up the chart, so I've got the bond market too. So it's not just stocks, right? It's
absolutely.
The bond market has been
horrendous.
on the struggle bus the last few years. So if you look at the last 3 years, the 3-year chart for AGG, which is just the core U.S. ag bond market, the iShares ETF, and then iShares 20-year Treasury bond, the TLT. So AGG is down 16% over the last 3 years. TLT is still in a 37% drawdown.
Is that price or total return?
That is price. Let me see. Total return 32 and 9.
Okay.
Down.
Yeah.
Mhm.
Oh gosh.
Yeah, down 9% and 32% total return. So, you go and this is the hard part. If you're an investor in mid 21 or early 21 and you're like, hey, I'm going to put money in a 20-year Treasury ETF. You don't feel like you're taking a lot of risk necessarily,
No,
right? And just
No.
As long as you hold for 20 years.
yeah, I mean, that's not the feel of what you're doing. Like, you're like, hey, this is a more conservative, it's treasuries, it's 20. And then you look up 3 years and you're like, I'm down over 30%. Like, how did that happen? And it's obviously because the interest rate environment
Right.
and the interest
Gosh.
rates went up so much. But that's just, it's investing is really stinking hard. And there are going to be periods of time where things perform and do what you might think and expect them to, and then other long periods of return where they don't. And diversification is still the right approach because you never know when that's going to flip. And
There's a couple stances that I'd like to take just on what we're talking about today. One is that small caps won't always massively underperform large caps. Another is that international won't always massively underperform U.S. stocks.
Mm-hmm.
Another is that bonds won't always be negative. Right?
I mean, and
I
there,
thought you
there's
said
like-
one take. You've got
That was three.
I said a
Okay.
couple.
Okay.
I just added a third.
I think
I agree with you.
I think there's some feeling that over the next 2-3 years, as rates begin to move down, that the bond market will begin to
Sure.
fare much better. I just lost my train of thought.
Well, the positive to that is like now you're getting, a new money going into some of those bond deals. Like you're getting paid yield. You're getting paid something for the first time in
Oh, sure.
years
Yeah.
and years. You
Yeah.
know, but if you bought early, if you've been a holder of those positions, like, it's been tough. And so,
Oh, I know what I was going to say. One thing that we have found is that there are ways to diversify without truly going into small, mid, international. There are ways that we can build diversified portfolios, and it's not unique to us. It's the industry has changed enough to where you can get diversification without specifically going into a Russell 2000 fund or ETF. But it's hard. I mean, it is hard as an advisor, as an investor, when you see the Magnificent Seven or the Magnificent Four or whatever it is,
I had a
continuing to outperform.
I had a prospect come in that we were running a first appointment, and they said, my advisor has massively underperformed the market. And I looked at the portfolio, and it was a well-built portfolio. They had different sectors of the market. And I don't know, it wasn't good for me, but I was like, your advisor's built a good portfolio. I mean, it's well diversified. You're invested well. Probably to what you were expecting is how you're invested. It just hasn't been a series of time that's been a good series for a well diversified portfolio.
well, and the people when they say, and we're all guilty of it. It's
We're
like,
all
is
guilty of
when
it.
you say the market. A lot of people are referring to the S&P 500, but that's not the market,
Yeah.
right? It's a
That's like saying
very important part of the U.S. stock market, but in terms of the investable market and the publicly traded companies that are out there, it's a pretty small.
Yeah, when we
sliver of
talk
it.
about housing, we're not just talking about the Hamptons.
right,
Yeah. Or Northwest Arkansas.
Yeah, we're not just talking about the super expensive parts of
Yeah.
the housing market.
Yeah.
so there. I guess the moral of the story is the market is not in this place where it's like things are so crazy good that like there's no way they can get better.
Mm-hmm.
I think if your argument is like, hey, we're going to enter into a tough stretch, there are definitely a handful of names that have some they could give up because of how well they've done over the last few years, but that doesn't necessarily mean the entire market is going to struggle, right? Do you really think your investors who have been all in or to a large extent in on NVIDIA and some of these big technology names and have just stuck with it. Do you really think those are going to be sellers who are then sitting on the sideline, or do you think that money will go into other names?
They'll go into something else.
I would suggest they would probably go into other names. Like,
Mm-hmm.
that's not money. That's not risk averse money, right? I mean, that's money that they're like, hey,
It's probably active managers most of the time.
yeah, like, hey, that's been great. Like, we've ridden it, but Nvidia's kind of seen their growth that they're going to see for a while. We're going to cycle this into some other names, and so. But the hard part, like that, when and how long it could go on is just impossible to know. You know, and that's what's been hard the last few years, and I think what will remain hard until you kind of see some of that start to happen.
Mm-hmm. The hard part, the part that's difficult to wrap your mind around sometimes is it can be right and performance look wrong.
Sure.
Oh,
And that is so very difficult to say. We're invested properly. Performance relative to the benchmark that you're stating is wrong.
Yeah.
But it's invested properly, diversified, how it should be invested for a good long-term 30-year retiree portfolio or 40-year retiree portfolio because people are living so long.
And the flip is true as well. I mean, you can have situations and time periods where the performance is great, but the investment
is wrong.
Is wrong.
Yeah, sure. Yeah, and
that will
I would take that one over the other.
Yeah.
That will be found out
Sure.
at some point.
I had a client that I primarily worked with a couple years ago. They left. They moved their account and really got along with this individual. Had a great relationship. And I told them, they'd kind of moved around a few times, and I told them, I said, hey, you really need to find a strategy that you believe in and just stick with it, because you're kind of setting yourself up for disaster the number of times that you've changed or have wanted to change strategies, because it's going to be impossible. I mean, the way things evolve and the cycles that the businesses go through in the market, it's just you have to you want to make adjustments and tweaks, and I'm not saying you don't ever want to make some changes, you do, but you've got to really believe in what you're doing and then kind of stick with it for the longer term, because you're going to get in these weird periods where they're like, you just feel like you're doing really poorly or really well, and you don't want to make decisions based off of those windows of time.
And I wish I had a crystal ball to see how long this continues to last. Because there's so much of me that says
I'd pay you a lot of money for that crystal ball.
A lot of people would. There's everything that you look at and read and study the charts tells you things should begin to revert back to the mean. Well,
this kind of stuff can run for a while.
It can run for a while.
And it has run, I think, for longer than some thought. And I think it doesn't mean we're at the end. It could continue.
And it doesn't mean it couldn't end today.
Yeah,
I mean, it's just we don't know.
I mean, but if you're looking at what would be a reversion back to the average, so we talk about reversion to the mean, you would expect, not anticipate, and this is not financial advice, but you would expect that small caps would outperform large caps probably over the next 5 years. I mean, that would be a fair expectation from this point forward, from July 2nd, 2024 over to July 2nd, 2029. You would expect small caps to outperform large caps if you're looking at any form of reversion back to what has been the average long term.
Sure.
So,
but that mean keeps changing as well.
Yeah, that's exactly right, and it's changing every day.
Sure.
Gosh, yeah. 3-year total return S&P 32, S&P 600 -2. It's just wild. Every time I see it, like I've seen that chart 500 times.
So before we got on the podcast, I took that and I started doing different time periods. So not with the end date of today, but instead end dates of years previous. Mm-hmm. And it looks completely different besides the period where you put the end date on today.
Oh, sure.
I mean, it just looks drastically different.
So develop a strategy. Be well diversified. I think that's kind of what we're trying to get at. It still makes diversification still it matters and makes sense.
Are you sure?
Yeah. No, I'm not.
I'm not.
Are we saying it with fingers crossed behind the laptop?
Just don't look at the last 3 years' data when you're trying to support your case
Yeah.
for it because it's hard.
That's any investment strategy. Look at different time periods, different market cycles, different environments that the strategy had been used or could have been used.
Yeah. Well, good conversation. A lot going on in the market. It's been a good first half of the year when you look at the S&P.
It was a good first half.
When you look at other areas of the market, it was not so great.
Yeah.
Kind of muted, not a whole lot going on. So
The second half is going to be interesting.
second half will be interesting.
There's a lot going on.
You want to talk about the debate? That was a joke.
No.
I don't want to talk about the debate. But
I mean, you should think what's going to happen in the next 6 months. An election, a Fed cut at some point in the next 6 months, whether it's
Potentially.
needed or not. You got a lot of stuff
sure.
that's gonna. Summer's typically slower, but man, come Labor Day, it is a sprint to the end of the year.
Then next year you've got a huge debate on tax.
Yeah.
Yeah.
You got Trump's tax cuts are
Coming due.
expiring.
Yeah, crazy.
A lot of moving parts.
Yeah, for sure. It'll be fun. We got a nice comment from a listener the other day. He said, great show. Appreciate you guys taking time to do these conversations regarding current financial issues. The way you guys seem to stay up to date on all things financial. So we appreciate the comment and appreciate all of you that listen. Give us a like, subscribe, comment, and we'll be sure to mention those that we can in future shows. We'll look forward to seeing you guys next week.
Have a good week.